Welcome to the MAD podcast. This is the platform where entrepreneurs share their experience of mergers, acquisitions, and deals. Now, in this episode number 6, Jeff Lermer explains how he bought 2 accountancy businesses. Now, many of you may recognize Jeff as a business advisor to many business investors, but he is in fact an entrepreneur in his own right. And in this episode, if I can get the words right, he explains how he sourced, structured, and closed 2 accountancy business. I hope you enjoy the episode. And don't forget to subscribe below, hit that notifications bell so you get the latest videos as they are launched, and connect with me on LinkedIn, and I'll speak to you very soon. Bye for now. So hello everybody and welcome to the MAD podcast. And with me today we have Jeff Lermer. Hello Jeff.
Hi, good to chat to you all.
Brilliant. Welcome to the show. And just to get started, would you be kind enough to share a little bit about your good self and your background, please?
Yeah, absolutely. I'm a chartered accountant, but proud chartered accountant. The great thing about it's a fantastic qualification. What it allows us to do is really help businesses. So I became a partner in an excellent practice when I was 29. Got to 38, and it was sort of time to sort of step out on my own. Set up JLA, and very much so. You know, we all have our sort of niches or areas we are good at and we enjoy working at. And I think probably if I tell you we've got 3 things that we really like adding value. The first thing is we like to act for successful businesses. And I mean what I mean by people doing well, people running good businesses, people making good profits. And simply the reason is we can add much more value if someone's running that sort of business because there's more to do, there's more to help with. So that's probably our sort of first bit. When I started as a partner in Sobell Rhodes or Bell before that, I was given a small portfolio of clients that was in the construction industry, and I managed sort of I managed to increase that from sort of by about 6-fold. But what it allowed me to do was understand construction, and I love so much sort of other sort of niche within it is construction. And I really enjoy working in that area. It's an area you know you're making the difference of. First of all, there's no sort of subtlety. I've known if I'm doing well or not doing well. People are pretty happy to say that. And I think also what's very nice about the construction area is that people are very much used to dealing with other professionals in that area. It's not, and so it's really cultural to do that. So I think that's really good. And I suppose if we're looking at sort of third thing we do is, and it was a journey that I started myself, and it's helping on buy-side acquisition. Because it's a sort of buzzy area now. It's got really busy, and actually it's a fantastic area for people who want to develop their business and grow in a way. Obviously buying income is a really good way of developing their business. So there's sort of 3 things we help on. We're based in North London, in Barnet. It's about 25 people in the team, and that's what we do. So from an accounting point of view.
Okay, brilliant. That gives us a bit of perspective about your good self. Now, we are going to come into talk about a couple of case studies, but before I do that, you mentioned construction, and also, which is kind of my sector, property and construction. That's my background. But what people may not realize is that you're a published author, or you're not. Now, I didn't know that. I've been following you for quite a while. Been looking at your LinkedIn posts, which are great, by the way. I love your content. And anybody listening, I suggest you have a look at Jeff's content on LinkedIn. It's very good. But this book, you very kindly sent me one, and I appreciate it. And I've read it, called Breaking Ground, everybody. And you're the co-author along with Karen.
Yeah, Karen and I work together. In the office, we wrote that because constructions are sort of art, so niche-wise, it's a really big niche, and there's a lot of information just to share around in that area. It's good to specialise, and we just want to sort of document how we help people and be specific about it. I appreciate there should be another a chapter added now from the changes on the 1st of March on the reverse charge on VAT, because that's a significant thing that's going to happen. In fact, I've got 2 people buzzing me to take, right, Jeff, make a video on that, make a video on that. So that might be my next task to go and do that. Actually, I will do that, because it's a big change in that area. So, but it's nice to specialise, and it's we got the big, that's the thing about accountancy and marketing. I enjoy accountancy and I love it. Marketing. So the 2 circles that don't touch each other is the Venn diagram of accountants and marketing. So we got this book done and got a few copies printed. And what do we do with them? We just stuck them in the loft. It's a very pleasure. If anyone is interested, just contact me LinkedIn. I will have pleasure in sticking a copy in the post. I'll throw in the postage, there's no cost, but this, I think it gives a nice idea, and also gives some ideas about running construction companies, what's important. So with pleasure, I'd like to be very happy to sort of send that around and free up some loft space.
Okay, there you go, everyone. Jeff wants to free up his loft space, get a free book by contacting him on LinkedIn. That's fantastic. Okay, so you've got a couple of case studies that you're looking to share, Jeff. And I know it's in the accountancy practice. So if you'd be kind enough to share with us how you source, how you structure, and how you close the deals, that would be great.
Absolutely. My first journey into acquisition came in 2004, and what happened was, I set up the practice. I set up JLA in 2003. And I was an equity partner, so I was allowed to leave with clients. Everything was done right. I must have done that right, because my legal fees on leaving that practice were a dinner for 4 at Quaglino's. So I think I follow the term of that agreement, because that's litigation isn't a lot of fun. So I left the partnership exactly as I was allowed to do, and follow the agreement completely. So set up in practice, everything was going great, and I wasn't looking to buy a business. We were doing really well. Working hard and doing well, and a mate of mine contacted me and said, Jeff, there's a practice I want you to buy. There's a practice you should buy. I said, yeah, his name's Paul. No, Paul, business is good. I don't need it. Everything's great. Said, Jeff, you should buy this business. He was bloody right. So what happened was, he introduced me to Arnold. And the thing about it, everything was nothing could have been more perfect if you're looking for an acquisition. The chap had 1 employee, which is his secretary, he had for 25 years or something. So there was no employment issues. He only used subcontractors. Rent issues, he was in service accommodation. There's no rent staff. It was in a sector we were familiar with. This entertainment sector. We got clients in that area, so we knew the area. And from a personality point of view, we were very, very similar people. And from a structuring point of view, we agreed to do that transaction. Initially, it was no consideration, down spread over 4 years. We actually, in the end, a small consideration was paid in advance, which was fine. And we looked at his business. We did an offer based, typically in accountancy practice, based on turnover. So we did an offer based on turnover. What was there at the end of the first year? It was one of those things that was absolutely beautiful. And it worked well from us, from our point of view. It worked beautifully well. From his point of view, it was, I think we were a low maintenance people, and we agreed to spread the payment over 4 years. What actually happened is the practice went really well, very, very well, and we got to just past the end of 2 years, and I had sufficient funds in the accounts to buy him out. And actually, that's what I did. Not because I had to, not because I claimed a discount, because I didn't. I paid there was no discount there. But I just felt it was the right thing to do. And I've always, I think in business we have got our own sort of parameters about how we deal with people. And I think, if you always do the right thing, treat people how you like to be treated yourself. So I was pleased to do that. We speak now, we chat now. So it was a good thing. And many people often, when you buy a business, it does, or potentially, especially in the accounting profession, you end up in litigation. It's just not necessary. You treat people nicely, and it works very well. So it absolutely worked from my point of view. Absolutely worked from his point of view. Everything was a really good fix. So it wasn't sort of. I didn't do. I mean, obviously nowadays it's slightly different. There's a lot more courses on buying business. Then it sort of worked my way through it. In the end, the solicitor was a sort of mate helped me with it. In the end, I did virtually the whole agreement myself, because it was so straightforward. I just thought that. Now that's not a recommendation. Absolutely use a solicitor. So, but I did that myself. and that they worked beautifully well. Then what happened is I've become I've been asked through clients, especially through Jonathan Jay, to present at his Dealmakers Academy, which I enjoy doing. And it was funny, sort of sitting in the room again, or as we used to, or whatever, sitting online, you get a bit of a buzz, and you get sort of, and it's really quite exciting because you're with some really massively talented people doing some really interesting acquisitions. The way Jonathan structures it is genius. And suddenly you get thought, actually, why should we buy business again? So which was interesting. So and I just got that just from the buzz of the room. Again, without really seeking out this practice, somebody referred someone on to me. I knew the bloke quite well, and myself and his son actually bought the practice together. He's based in Glasgow. I didn't know Glasgow massively well. I do now. I do know a bit more of it now. It is such a cool city. It's like if you, and it's actually much more metropolitan, much more sort of me than Edinburgh. Edinburgh's very professional. This is much more sort of, I say, gritty is the wrong word, but just some really interesting people. So I'm getting to know Glasgow very, very well. And that's gone superbly well. Again, we've been able to pay off the vendor quicker than we imagined. The profits of the business are good, profits are rising, and it's working with a partner in that business Michael is superb, and that's gone very, very well. In fact, I think our profits have sort of gone up maybe 70% in the first year when we bought the business. So that's my involvement is more, I'm going to say, more sort of chairman strategic, this and the other. Michael's grown massively as well. But it's great working together in that. So so lessons one. The first one was really, it was the right purchase. It fitted into the business and wasn't sort of, it was low maintenance. We look after ourselves. The second one was really working with a business partner that works very well. As far as I'm a big fan of, if we say, on partnerships. Limited companies, you follow rules when you buy businesses or when you work with a partner. And I'm going to say, in effect, you're splitting profits into three tranches. The first tranche, if anybody's putting money in or different amounts of money, they should get interest on that money, or different amounts of interest, because if they're putting different amounts of money into, that's the first thing. The second thing is, if anybody's working in the business, they should actually pay the market value for what they're doing, because otherwise, if you don't, then people are going to feel, oh, I'm doing all these hours and the other person isn't. So always pay market value salary, and after that, split on the profit sharing ratios. So I think that's a real key thing for when you're taking on partners, to get that right. So I'm always a big fan of putting that into any agreement. What he wants is an agreement that's not going to fall apart, that people are going to work together and feel valued and feel sensible. So that's my sort of a couple of experiences. Turnover-wise, the first one was around 200,000 turnover. The second one's around 800,000 turnover. So they're good. The second one is a much larger business, and that we're doing really well with that business. We're switching on some really good marketing, to good people up there. So, and I think what's nice is with anything is with that one, we're both adding value in that business. Michael's working really hard on it and doing really well. I'm sort of also giving that sort of strategic look on it. And Matt, the owner, great bloke, very sensible. I think he'd come to a time, he'd added a massive amount of value into that practice. I think it was probably the right time in his life to move on, became a grandparent, whatever. And so it was a great thing. So we looked at that, we looked at the numbers. With any acquisition, I'm only going to make an offer if you get the numbers right. I looked at one, I'm rabbiting on too much, but I looked at an accountancy practice in Manchester that was a superb practice, beautifully run, really good team of people. The location was fantastic, just off Canal Street, brilliant building, Victorian building, it's so cool. And it's like, I wanted this practice, and really good quality clients, but I couldn't get the numbers to work. It didn't fit into a series of numbers which would have both allowed the owners to leave with enough money but they would have been happy with enough money for me to sort of make on it and grow it. So I think sometimes there is no harm as a lesson in saying, you know what, it's a great business, it's not for me, and that was a good thing to do. It was the right thing to do.
And Jeff, that's what I wanted to ask you about, because there were people listening that think, right, well, I'd love to buy an accountancy business or a service-based business. And I guess one of the challenges is and maybe you've highlighted it a little bit there, if you can't agree on a price or their expectations are too high, but often these businesses don't have any assets. And if you're trying to buy them without using, I was going to say any of my own money or very little money, then I guess it's often a case of, well, what are your options here? Is it just offering or asking for, or often, should I say, deferred payments, or an earn-out kind of arrangement? How do you see that?
The way I see it is, I suppose, when you look at any business, they may not have any formal assets. They may not have a property. They may not have a significant debtor book or whatever. There may be things that don't look like assets, but you can actually often see what's within that business. I'd say sometimes on debtors, they can be financed. You can go to an invoice and discount company and raise maybe 60 or 70% on the value of the debtors, which is quite good. You can do similar sorts of things on the work in progress within a professional practice. So there is some money you can raise off the business. It's not necessarily easy. Now, what's happened obviously recently since COVID, the Sobell loan is like unbelievable. It's the most amazing opportunity to buy businesses, because in effect, it's not quite 25% of turnover. It can be other ways of getting to that number as well. But if you have the right, if a bank is there to help, you can raise a significant value on that business that will make a big difference. So I say if it's 25% of turnover, which it can be, you've got a situation obviously up to 250. The guarantee situation is got all government stuff. So there is stuff you can go off the back of a business without any formal assets within that business. Now, the Sobell thing is going to stop, and it's going to stop at 31st of March. It's been the biggest gift ever to help buy businesses, because it just works beautifully. But even going forward, working with, I'm not a finance broker. We've got great finance brokers we recommend to. I love working with a good finance broker, because you sort of say, fine, here's the, we had a woman called Gillian, here's the company, what can you get out of that company? And it's great, because you suddenly sort of see what's in there. It doesn't mean these transactions are easy. From a personal point of view, the first one I did was a no money down deal, but it was never it wasn't necessarily important, but that's just how I did it. The second one, I did put money into that transaction. I was happy. So if you got nothing to put in, then that would be harder. You've got to sort of see what works for you. Sometimes, if you've got no assets or nothing you can borrow, and then that is a problem. And it may well be it has to sort of walk away, or you pay a bit more. The thing about it is, people aren't going to sell if they've got a business that's of value and they're not feeling as though you're putting any sort of risk or stuff for yourself in. Then sometimes there's a view, well, actually, what are they actually doing or she's doing to take over that business? So sometimes I was helping somebody looking to buy a business. It was a great business, and we were things enough to get we're moderately close on numbers, but the person was unhappy because he wasn't even the number. He was happy with the number, but he didn't feel the person buying it was suffering any pain to buy it. There was no logic for that. That deal fell apart, despite the fact it was a beautiful business. It was making 525 EBITDA, and there was £1 million cash in the company. We agreed to do a deal around 2.4. So it was a deal that really should have happened. We got a Sobell's advance of about 600, so we grew up to about 1.6 on the 2.4 valuation. They weren't very far short of each other, but he wasn't happy because the acquirer wasn't putting any money in. So sometimes, now I can't help that. If someone's positioned in that way, then the deal's not going to happen. But it's funny, it was a deal that actually should have happened. The person acquiring it would have done really well with that business. The person selling it actually would have allowed them to move on to the next stage of their life. They wanted to take their boat out and lovely. So really good things they wanted to do, but for whatever reason, internally they couldn't do it, which was to say was a real shame. Sometimes you can turn people, and sometimes not. What people is selling a business like that, they're not going to want to sell to an idiot. They're not going to sell to someone who doesn't know what they're doing. I did a LinkedIn post about the so-called £1 Charlie, which is a sort of an expression certain people use about people buying things for nothing. I think it's a derogatory term, because it's implying somebody as well as putting no money down is a bit stupid. I think there are some very clever people putting transactions in place that work very well from a vendor's point of view, and they're certainly not idiots. So I think but obviously nobody would want to sell to someone who doesn't know what they're doing and comes up with nothing. So I think there's a degree of balance, and sometimes you have to get that evidence across and show that credibility.
Yeah, yeah. So Jeff, you mentioned EBITDA earlier, and I know you're consulting with clients, you're helping them to buy businesses. My question's about valuing businesses. There's lots of ways to do it. From my understanding, multiples of net profit, EBIT, EBITDA. But what's the one that you use and recommend, and why is that?
That's a really good question. There isn't one valuation there. The purpose of a multiple of profit. When people buy a business, what are they buying? They're buying future cash flow. That's what they're trying to value. And so any mechanism to get to that number is important. So typically, if somebody was buying a construction company, I would say the value of that business, you would look at net assets, so what plant, pit, whatever they've got within it, that's part of the valuation. You look at contracted work, so fine, they've got a £1 million worth of contract, they're going to make a 20% margin on, so there's 200,000 for that. I wouldn't value much more than that, simply because you buy the business, that's all you're buying. No, there may be no more contracts going forward, it's all one-off bespoke work. Now, you can look at the same turnover business that might have 50% of its income, so it might even be in the same sector, 50% of its income might come from service income. So maybe I'm going to give an example of a business that supplies, installs lifts and gets maintenance income from the lifts. Now, the supply, putting in new lifts has probably no value at all other than what's contracted. The maintenance business is massively valuable. So it's sort of standing back and really understanding what people look at. So there isn't one overall number. Always, you should look at the likely cash flow that business is going to generate. Because when you buy a business, you're going to need to pay for it. And does it make sense? So you do it, you look at it, what's contractually bound, what's not contractually likely to come in, the quality of the customers, the variety of customers, is it all through one customer, all these sort of things. Now, that doesn't mean, even if it is all through one customer, it doesn't mean you shouldn't buy it. All it means is you should structure it in a way that de-risks it from an acquirer's point of view. So it may well be from a less customers or a construction type company. You might do it based on a royalty payment. You might say, look, net assets of 50 grand, so fine, that's a basis of valuation, and I'm going to make up a number, 10% of turnover for the next 4 years. Now, that would be a deal that potentially would work from an acquirer's point of view, because they're de-risking it, it's going to be based on turnover. From a vendor's point of view, you know what, if they want to get out of the business, allow them to support that business, make sure new contracts are going in, and actually help it. But then no one's going to pay any more for that business. They might pay it, if the management buy it, they might pay a bit more, because there's loyalty issues and stuff. But generally, a third party wouldn't do that. So it's really just looking at the business, looking at the cash flow generated, and make sure you can afford to buy it. So there isn't a one magic thing. Sometimes I do it on the assets, sometimes I do it on a multiple of profit, sometimes I do it on the cash that's generated, sometimes you do it on the EBITDA, so you look at the expenses. Now, EBITDA is an interesting number insofar as you're looking at the cash being generated. If you've got to go and buy a whole load more assets, you've got to put that into the calculation. You're going to have to borrow money, you're going to have to buy those assets to actually, if you ignore that number, the thing about EBITDA is the idea is you can compare two companies and exclude the cost of depreciation, exclude the cost of interest, because one might be financed one way and one might be financed another way. So it's a good way of comparing two companies, but it's not necessarily a great way of valuation. It just has been used for valuation. So the theory of valuation, I really enjoy the theory of valuation. I'm not here actually, back in the office, got a great book on valuation options, and it is a theory, just as well. Hanging the seaweed out the window is probably just as good a valuation method, and which way the drops go. They always know. I'd love to say it's a massively scientific thing. It's absolutely not. It's you're trying to work out what cash a new acquirer will get from that business. And that's something we use shorthands, or like the way our minds work, always work around shorthands to get to that number. So multiple profits is a good thing. I was working on something with somebody yesterday, and we were at the business in their particular sector was pretty much value based on turnover, but I actually didn't like that as a basis of valuation for particular reasons. So I went to a multiple of profits, and 3 times multiple I think was the right thing. So we had these figures, and we had to adjust for market value salaries and rent and a few bits and bobs that were in there or weren't in there or double counted. And the multiple profits, in fact, there was 4 sets of accounts, and it was interesting. They all sort of overall looked a bit the same from the outside. We got into one, and I said, and it was interesting. We started playing the numbers, like, this sucks. These numbers are terrible. And she said, yeah. And she said afterwards, yeah, actually, when I looked at the cost structure, they were selling their product at about half the price all the others were. It was really interesting just by looking at the numbers, like this business doesn't work. Well, it worked, but we will only offer to buy that business. She will only offer to buy that business based on a multiple of revenue. So I can't remember what was suggested, 15% or 20% of revenue for the next 4 or 5 years. 3 years, can't remember, something like that. We just de-risked it from a purchase point of view. So there isn't. Sure, I love to say there's one number. There isn't.
It's about creating a bespoke solution for each opportunity.
Yeah, it's about that. It's about working what the cash flow is, what the likely cash flow is, and whatever we need to do to get there. And it's not. And businesses are different. Categories of businesses are similar, but they are different, and the nuts and bolts in business and the personalities are different. So you need to sort of get a real understanding of that business.
Okay, brilliant, fantastic. So what are your top tips for people looking to buy their first business?
I think if we're looking at top tips, the first thing probably is to understand the sector you want to get into, either because you've already worked in it. So for me, buying an accountancy practice was a completely logical thing. So understand the sector, because you can then add much more value on it. If it's not a sector you know, then really do some research in that sector and see how it fits together. It was interesting, on this person I was talking to yesterday, she wants to buy into this sector. She actually hasn't got any experience of it. She's actually a business coach, she's a brilliant business coach. She will do really well in the sector. But it's funny, it's more appealing from a vendor's point of view to sell to her because she's not in that sector. I quite like that, and she's gonna use that in her sort of marketing way she talks to people. So I think the first thing you say, get a sector that works for you. Either you've got experience on it, or you know it, or you can know it, and probably sort of stick to that. Make sure there's enough profits, obviously, in that sector. So that's the first thing in that, because you can talk sensibly and that sort of add value from a, you don't become a naive purchaser. If someone wants to sell their business, this is something they've worked for years and they love their baby. It's very important to them. So if they're talking to somebody who doesn't really understand their sector, it's going to put them off. Even as far as using the right language in that discussion. If you're going to talk, I'm going to say double glazing, what you're going to talk about, fabrication, you're going to talk about frames, you're going to talk about whatever profile, you're going to use the right words because it matters. It shows you know the sector. So that's important. I think once you've got that in place, as far as the offer goes, that's important. Structure of how you acquire it, that's typically where we get involved in helping with the structure, is really important. And getting the acquisition vehicle right, de-risking it from your point of view, ability to use losses, that sort of thing. So getting the structure right is important as well. Working with one of my business coaches, a chap called Paul Avens, he uses the word power team. I think it always sounds a bit arrogant, Sean, when he said, well, I'm part of the
power team. Sounds good.
It's great, isn't it? But I feel a little bit embarrassed about using that term. But but that's, you can see why. Having people around you that support you in the bits you need. So working with a good M&A lawyer, working with accountant or tax advisor, working with finance company, working with people who absolutely aid that valuation is really important. The trouble is, we're trying to buy a business without much money down, then obviously we're putting cost structure in this, but it gives you a much better chance of the transaction working well. To get the first one for nothing, So for the alternatives, you've got nothing at all. You could try and get something underway that you're going to make a bit of money in, and then with that, use that to build and learn on. One can do that. That's quite hard to do, but if you've got no assets, then you've got no choice. That's what you need to do. So I think probably those, if we're looking at sort of initial tips, those things will be really important.
Okay, that's brilliant, Jeff. So just to summarise where you're at, you bought a business for 200,000 revenue, you want 800,000, so $1 million in revenue. I kind of just wonder what your strategy is now. Are you happy with where you're at? Or are you still looking to grow? What's your thoughts on that?
I think I'm not actively looking. So people like Jonathan, whatever. I'm not sending out my 1,000 letters on that at the moment. Where we are probably looking at one particular sector. We actually are sending out some letters. Strategy-wise, sure, I'm old. You see, I'm 56. I want to be sitting with my feet up and pushing my grandchild away in his pushchair. That's what I want to do. Or whatever. Spending more time in the sun. I remember that. We used to go on holiday. I have that memory. So I'm not. I will look around and I will see what comes up. I'm not from a JLA point of view. We're doing a lot of structural change in the business. So the first stage is actually making our practice significantly more robust and stronger. And we're looking at things doing that. So I'm not looking to bolt on acquisitions at this stage. I think when we get the infrastructure where we need to be, then bolting on would be useful. But I'm not looking at this stage because things would just creak a bit. Always flexible. The thing about it is, they describe it is, I feel I'm like a fish in the water. You know what? I'm swimming along and I might be quite happy and quite chilled and not really worried. You know what? When that maggot's in front of me, I'm going to look at it. I'm going to look. I think people running businesses always look at opportunities, and I'm always going to look at opportunities. And some things I like and some things I don't like. I invested in I took a marginal investment, small at 30% interest in a marketing company, digital marketing company recently, and it was an opportunity that came up. People I know, like and trust, brought something to me, and thought, actually that works really well. They're doing brilliantly. They're running. My involvement in it is typically limited to sort of monthly board meetings, a little bit of strategy, but not massive. But actually, the templates we've got within that business, it's going to be fantastic, and we're going to be able to use those templates for future bolt-on acquisitions. So me, I'm the fish. I'm looking around. I'll have a nibble if it looks good. I'm not actively seeking, but I won't actively reject either. So that's where I am at the moment. But it's really, from my point of view, developing JLA as a practice is really important to me. That's my number one priority.
Yeah. Okay. Oh, well, it's been great, Jeff. I've really enjoyed listening to your case studies. You've offered a lot of value, or given a lot of value, should I say, to the audience today, and I appreciate that. So how can people who want to get in touch with you, maybe they have got a deal that you think might be interested, or your consultancy service helping them grow their business, how can they contact you?
The easiest way probably is through LinkedIn. That's an area I've decided to be much more active on. So Jeffrey Lermer, just on the LinkedIn. I think there's only one. Well, there's only one Jeffrey Lermer. There may be some other Lermers. So that's probably easy to find me. The practice is jla.accountants. Look at the website, which is being enhanced by the digital marketing company we bought. The existing one's horrible, but hopefully the new one will be significantly better. So yeah, just reach out, and we can. What we need to do is I get some information from you, make sure I understand what you're looking for, make sure we can help, and then we can book a chat and take it from there. So yeah, I'm not. I don't want to be whatever London's or UK's biggest secret. I think that's probably not a good idea, is it? I should get myself out there a bit. So, but LinkedIn is probably the easiest place to contact me.
Okay, well, thanks again, Jeff. Don't forget, you can get that free book, Breaking Ground from Jeffrey. He will send you a free copy. It is fantastic. I've read it, and I highly recommend it. So thanks again, Jeff. It's been great having you today.
No, pleasure. Nice to chat.
Well, Jeff Lermer really is a wealth of information. I hope you enjoyed that. I know I certainly did. Well, in the next episode, episode number 7, we have Lorna Coronado. She's a high-profile business investor, and she talks about her first acquisition in the health and wellness sector. It's absolutely fascinating. So join us for that. Don't forget to hit the notification bell so that you have the latest videos as they are launched, and subscribe to the channel below. And don't forget to connect with me on LinkedIn, and I'll speak to you very soon. Bye for now.